Starting off on the right financial foot is essential. Joining me now to break down how to do that is Beth Kobliner. She's the author of Get a Financial Life. Beth, welcome. Good to see you.
Great to see you, Jay.
All right, let's start with young folks, just out of school. I've read that the average senior in college has something like $20,000 in college debt. Now, that is a lot. You say pay down your debt, your college debt and other debt, but how realistic is it that people can make a lot of headway against that?
It's so difficult. And I think the most important thing is to look at what debt you have. They have $20,000 in student loans and $2,600 in credit card debt. And a lot of people feel overwhelmed by their student loans. They want to pay that off as quickly as possible.
But that's a low rate debt, right?
Exactly. So you want to start paying off that high rate credit card debt more quickly. One idea could even be stretching the term of your student loan over, say, 20 years, lower the payment, but use that extra cash to pay off your high rate credit card debt more quickly and stop using your cards.
Well, yeah, the better moral of the story there is to stop using your cards.
Absolutely.
Now, you guys did a survey, which I found really interesting, about what people know about their credit cards. The answer is not a lot.
That's right. It's hysterical. When you ask people, do you know who Tom Cruise and Katie Holmes' daughter is? 78% of the people knew it was Suri. Do you know that?
Yeah. Well,
Suri.
yeah.
Not sure. Now, when it comes to your credit card interest rate, 45% only knew their credit card interest rate. So it's 78% know the celebrity gossip and 45% know their credit card interest rate.
It's not surprising, though, I have to tell you, and it's something that we deal with here all the time, people not understanding their credit cards, the terms of their credit cards. And for people in their 20s, that's absolutely essential. Now, when you move to your 30s, though, the priorities become something different. Now I'm starting to think about, hey, you know what? I might be able to buy a house here. What's the reality, though, for people getting into the housing market now? Because now you've got to put down 10%, 20%.
It's a very different world out there. In 2007, the average down payment was 2%, and 40% of people put down 0%. Very different world now. Like you said, you need to put down 10 to 20% in order to get a home loan. You need to come up with, that big down payment, plus you have to have great credit. And that's why it's so important for young people to do. Maybe they can't pay off all their credit card debt, but they want to at very least make the on-time payments.
There's a theme here.
On-time payments.
And also, of course, contribute to your 401k and your IRA.
Absolutely.
I want to take an iReport. We have a question for you, Beth, from an iReporter. Let's listen to that.
I got a car last summer, and I have a 7% interest rate, and I'm seeing all these commercials with all these car companies offering 0% interest. So my question is, if I return my car and and get a new car with 0% interest, how that will affect my credit if I return my car?
All right, so should I trade in a car to lock in a lower interest rate?
The answer is no. Because even though it's very tempting and a lot of car manufacturers are offering these great 0% deals to sell their cars, and if you don't have a car, it is a good time to get a car loan. But in her situation, because she's had the car for 1 year, it's depreciated dramatically. So she's going to have she owes much more than the car is worth, for starters. And also there are taxes and finance charges when you refinance. I would say for her, what she might want to do is see if there's a credit union or bank she can actually refinance the 7%. The national average right now is 6%. So maybe she could even get 5%. It's tougher to refinance an auto loan, but it is doable and it's worth checking out.
And the 0% offer is just hard to walk by, that's for sure.
Very
Let's
hard.
talk about being in your 40s a little bit. Now, a lot of people will have kids by that time. They're starting to think, how do I pay for their college education? They have lots of demands on their money. What is their priority?
The priority is retirement, because you can borrow for college. There are still great student loans out there, and they're still available. Stafford student loans at pretty low interest rates, plus loans for parents.
And there are even better deals now that we've had the stimulus package.
That's right, absolutely. But you cannot borrow for your retirement, and that's the hard lesson a lot of people have been learning.
So in your world of priorities, it starts with retirement by the time you hit your 40s.
Absolutely. Even in your 30s, start in that 401k. And if you're nervous about the market right now, you could still put money in your 20s in a 401k. A little bit, and if you're super nervous, you can put it into something super safe for the next year or two. But if you're looking over the long term, putting into the stock market, 20, 30, 40 years, you're not going to touch it, it makes sense.
Start investing in that 401k at all times.
Absolutely.
All right, thank you for that, Beth Kobliner. Time now for the bottom line. Get an early handle on your debts. Make sure you take the time to review